Hey, everybody, this is Jerome D. Love, Managing Director with Ironwood Capital Consultants and partner with JDL Equity Partners. And today I'm here with another market update on Texas real estate to kind of let you know what's going on. And actually, this one's going to extend beyond Texas, it's going to go all the way national. Now, I was reading this report by Berkadia, and they did their August 2025 quarterly market update and has some very interesting information. And I wanted to share it with you. The crux of it is the rise of single family rentals and build to rent communities. It's one of the fastest growing segments in the United States housing market. Now, for those of you who don't know who I am, I want to take a minute to kind of explain to you who I am, how I got into real estate. I've actually had my real estate license for over 28 years. I got it 20 years old when I was in college. I bought my first house when I was maybe 22, around 2001. But I won't talk about that part of my real estate career because I made a bunch of mistakes, lost a bunch of houses, and then I started back in 2011 with investing in real estate now down the trajectory that I'm going now, and it's been quite profitable for me. But in a nutshell, I buy and rehab and I hold long term. The first house that I bought was $10,000. I bought it at a tax auction. Took me $25,000 to fix it up. So a $35,000 investment. At the time it was completed, the house was worth about $60,000, $70,000. I doubled my value. Plus, I rented it for $900, $10,800 a year. Pretty much, I'm making over a 30% return. Now, that was probably one of the best investments that I've ever done to date. But on average, most of my houses were costing me somewhere in the neighborhood of about $30,000 to $40,000 to get them, $20,000 to $30,000 to rehab them. So I'm in it for about 60, maybe 70,000, and they're worth 90 to 100. So I go in with about 30, $40,000 in equity, and I'm making somewhere in the neighborhood of about a 15 to 16% return on the cash on cash return on investment. But a funny thing happened. As I told you, I started in 2011. As time started to go along, the prices started to go up. And the last house that I bought, which was in 2020, February 2020, I ended up buying that house for $60,000. And then to repair it, it was a burn damaged house. I put another 60 in it. So now I'm in it for 120. And of course, the prices are a little bit more then. The value was probably about 160,000 when I was done. So I have 40,000 equity. I'm renting it for 1,300 or so a month. So I'm making 18,000 or so a year, a little bit less than that. But now instead of making 15 to 18% returns, I'm in the neighborhood of about 12 to 14. So then I had a thought. I said, man, I could buy a lot of land, a piece of land here in Texas and in the neighborhoods that I work. I could buy it for maybe 60, 70,000. I could build the duplex for 200,000. So now you buy the land for 60,000, build a duplex for 200,000. That's a total investment of 260,000 divided by 2. That's 130,000 per unit. It's almost the same as what I was doing with the single family. The duplex is now worth 400,000, so you have over $100,000 in equity, and the return that you're getting is 15% or more. So that was the path that I was going on. In addition, you have a brand new property. It shows better. It's going to rent for more. That was the path that I've been going down over the last few years. So when I read this article, it really kind of struck a chord with me. So first thing, let's go macro. Macro, everybody knows what's going on in Washington with these tariffs. So the nutshell of the macro portion of this article is everybody's trying to figure out how it's going to shake out. No major moves are really being made. Everyone is suggesting that there's probably going to be a rate decrease next month in September. But right now, everybody's kind of figuring out what's going to happen with the economy. So no major moves are being made. Now to the subject that I really want to talk about, this trend of build to rent. Now, the housing market is resilient, but within the housing market, there is one asset class that seems to be outpacing the rest, and that's build to rent. Why is build to rent surging? According to the Urban Land Institute, single family rentals have outpaced both for sale homes and multi-family apartments. Now, I'm going to say that again. Single family rentals have outpaced both for sale homes as well as multi-family apartments. Now, the reason is very simple. our lifestyles are changing, whether it be millennials, Gen X, or baby boomers. Everybody is opting more for space and comfort, and they can get that with a single family home. But they don't have to have the burdens of ownership, nor the down payments, nor the mortgages, nor the home repairs if they rent the house. And that's where everybody seems to be going. So when you look at a build to rent model, what are the value propositions, if you will? First off, it's maintenance free living. You have a bigger backyard, you have a little bit more privacy, and it's better options for you and your family and your pets. And it's better security and serenity. Okay. So it essentially gives you the best of both worlds. You have a house, but you don't have to have the cost that's associated with the house. Now, let's compare the build to rent with apartments. Now, you could say you can rent a house, you can rent an apartment. What's the difference between an apartment and a house? More space, more privacy, as we just said, and it's more pet friendly. So it's very competitive. But now let's look at it from an investor standpoint. Why would an investor choose to build a house over building an apartment complex? Well, on average, the rents in build to rent communities that are single family are 20 to 25% higher than multifamily. The tenant base tends to be a little bit stickier, means they're going to stay there a little bit longer. You have a house, it's a nice house, it's a nice community. You're going to stay there longer than an apartment complex where you got your neighbor above you making noise, and it may not have all the amenities that you may necessarily want. And the demographic tends to be a little bit stronger, so you have a better renter, if you want to say it that way, in a build to rent community than you do in an apartment. And the market is still undersupplied, so it's creating a double digit rent growth year over year. So what does this mean for investors? It means that you need to be thinking about this build to rent model. Okay, because it offers a stable demand and it's also a premium on returns. Now, let's talk a little bit about where the capital is flowing. So there are some markets here that I want to go through, and it kind of talks about, you'll see on your screen where the build to rent is really taking off, mostly in the Southeast. So you'll see here Atlanta is up 20, they have 28.4% of all their rentals are institutionally owned, so meaning investors. Jacksonville is 26.1, Indianapolis 22.5, Nashville 22.4, and Charlotte is 22%. So this model, if you will, the build to rent, is starting to take on take on steam, catch steam, if you will. Now, as of this report here, we can see that there are some opportunities that are out there because the build to rent is becoming bigger in the Southeast, but there are some markets such as Myrtle Beach, Port St. Lucia, Wilmington, North Carolina, Boise, and Huntsville that they have a net migration growth, meaning there are more people moving there than they have housing. And it seems to be that this building to rent model is going to be something that will be strong there. So if you look at your screen, you can see a comparison of the average home prices from 2019 to May 2025 in these markets. So you'll see that in Boise, the average home price was $367,204, and in May of 2025 is $629,900. And you can see that across the board, the change in prices. Boise is up 71%. So what is that saying? The price and the cost of owning a home is going up. Now, when you look at a comparison of the cost to own a home versus the cost to rent a home in these same markets, there's a high end looks like about an 1808 difference, low end $153. So these are some markets that if you're interested in considering this build to rent market, you might want to look into because the populations are shifting to these areas and there's certainly a demand for the product and there's not enough supply right now. On the financing side, banks are offering construction debt with spreads in the high 100s to the 200s, with debt funds ranging from the 400s to the 200s and loan to cost ratios up to 80%. Even more interesting, there are lease up bridge loans for build to rent projects post construction. These provide developers a compelling way to stabilize and refinance or sell into the strong demand of this new market. Now, let's talk about what you as an investor should be thinking about doing if you want to get into this market. And really, let's just say if you want to make money. Because one of the things I learned a long time ago in business is don't create the product before there's a market. So there's clearly a market here. So if you're trying to make money in real estate, you need to be moving towards this direction. So number one, follow the capital. Target growth markets such as the Southeast and all the markets that I just shared with you. Consider a hybrid strategy. Scale your portfolios of single family homes and capture the build to rent communities as well. So if you're a builder, maybe you sell some of your homes, but if you're not selling them, go ahead and rent them. What's the harm in that? I'm actually doing a development here in Houston. We're going to have 92 rooftops and we're going to sell those lots. The number one candidate to purchase those lots right now is actually a build to rent community. I went and looked at one of their other ones. It's no different from an apartment complex. They have a leasing office. You can put your repairs in. They'll cut the yard. There is an additional fee that they charge. So the rents are a little bit higher. The maintenance is a little bit more too, because in essence, you have a full-time staff that's servicing and maintaining the apartments. But overall, the net income and the ultimate value is higher. So pay attention to the financing and things that are going on as well, because the financing is becoming very favorable for these demographics. So now think long term. Demographics are destiny. Millennials forming families and boomers downsizing are the tailwinds that's going to fuel this build to rent new market. Now, let me tell you how I'm thinking as an investor that already owns houses. This is going to put a lot of pressure on me because, like I said, the community that I looked at, man, it was impeccable. It was nice. Now, my houses are decent. I put them together pretty well. I'm not a slumlord by any means, but the reality is I can't compete with these communities. I don't have a pool. I don't have someone cutting the yard. Matter of fact, one of the reasons that I love what I do is the tenant pays all the utilities. The tenant cuts the grass. So they don't have to call me for anything but to pick up a check. So the reality is this. I'm not going to be able to compete with these build or rent communities. They're going to be able to get more rent than me. But I'm looking at really seriously upgrading my units to make sure they're as nice as possible. And then also maybe offering a few more services, maybe throw in a water bill or something where you can be able to compete. But the reality is you're probably only going to be able to compete with them from a perspective of price. So as a landlord, my primary concerns is that tenant expectations are starting to rise. They expect the fenced backyard, the maintenance packages, and all the amenities. So I have to kind of up my game, make it a little bit nicer, and be able to offer a little bit more. Now, the higher income renters may be drawn away from the traditional renters. So, as a landlord, here's what you can do. Bottom line, you're going to have to compete on the price. You may not be able to match the amenities, but you can offer affordability. You also have to target stickier tenants, okay, families, pet owners, long term renters that prioritize stability over the flash. And then you're going to have to start doing some strategic upgrades. That's kind of what I'm doing now. I have some properties that have older roofs, they're functional, but they look a little bit raggedy. I'm thinking about changing those now. I've already kind of been systematically going through my portfolio. Some of the ones where I didn't upgrade to kitchen, or I went to Home Depot and got the Formica counters. Now we're putting the granite in, the tile backsplash, and some of those types of things. And then you're also going to have to lean a little bit more towards service. Like for me, one of the major benefits of investing in real estate the way that I've done is pretty much turnkey. I treat it as though they pretty much own the house. They have a repair deductible that they pay. The rents are reduced, but there's a kind of a value exchange. So while build to rent raises the bar on existing landlords, you can adapt and use the strengths that you have. So here's the bottom line. Build to rent is the fastest growing segment in the U.S. housing market right now. It's fueled by lifestyle shifts, premium returns, and demographic growth. Investors should be looking at ways to ride this wave, okay? And existing landlords should be preparing to adapt and to compete. Now, I'm Jerome D. Love with Ironwood Capital, as well as JDL Equity Partners. If you're trying to invest in Texas real estate, DM me. I love to work with you. If you found this valuable, make sure you hit the like, share this with someone else in real estate, and subscribe for more insights. See you next time.